Get an update on the markets today from Abdul Garba, a research analyst at Dundee Merrifield. Abdul, thank you very much for joining us. So it seems the market is starting this, well, it feels like a new week, is only after the holidays, of course, but the first trading day of the quarter. Can you just give us your thoughts about the mood on the market right now? It seems it's starting pretty well.
Well, we can attribute this to the new trading platform. There appears to be more transparency within it, and the brokers who utilize this trading platform are able to match more orders. So that could be responsible for the increased volume and participation.
I'm going to be talking about that new trading platform when I speak to Adebajamo, director at the NSE, later on. But do you think this is a game changer for the market? Could this lift the market? Because like I mentioned earlier, there is a sense that this market is likely to trade the same way it traded in Q3, or do you have a divergent view on that one?
No, there's no divergent view. On the overall, the level of the market was probably found its own defining point on the U.S. markets, the U.S. economy decision to be made by, which was made by Ben Bernanke, and not intervening in the financial markets, and that basically drove some aversion in equities markets worldwide. So that was probably responsible for why we had that up and down or sideways movement for the exchange.
All right, and what are your thoughts on the economic factors such as the Naira? I think that's another discussion point, particularly for foreign investors who, of course, will bear the brunt of any Naira weakness. Your thoughts about the importance of the Naira in Q4 for this market?
Well, the importance of the Naira certainly will determine the way, the perception of risk in investing in Nigeria, in that a foreign investor trying to inflow funds to basically take advantage of lower prices or a low price level could lose if the investor decides to take out the money, if that does not match his expectations for return. So yes, that could bring in aversion more to the amount of participation or the level of participation in the market than essentially withdrawals. Only shocks could prompt withdrawals at this point.
Okay, Abdul, your take on the banking sector. It's supposed to be the sector that provides the best valuations, but I think there's some aversion there. In Q3, we saw it underperform the market. Indeed, it was in the red. If you look at the sector as a whole, many of them posting negative returns for the quarter. So do you think anything is likely to change in the fourth quarter? Of course, earnings will be really driving the perception of the sector going forward, and we would begin to see that at the end of October.
Yes, on the overall, the regulatory impact, which involved the CRR, for which public funds basically would have to be matched with about 50% from the banks. That had shown some impact, registered some impact over the last 2 months or so. But in terms of earnings for Q3, which we're expecting, it's not on the overall likely to impact it on the full. A more settled level should be visible by Q4.
All right.
Yeah.
Okay, but if you want to pick stocks in that sector, which stocks do you like right now?
We will certainly like First Bank. Why? Because it appears very at a discount to its accounting value. It looks relatively cheap and versus its own peers. And because it is a top-tier bank and it has a strong franchise for financing itself. On the other hand, we have Zenith, which comes second to Guarantee Trust Bank in terms of return on earnings to equity investors. And it also looks attractive on that side. We also reiterate our position on Sterling Bank, which it has shown its resilience through cycles, both in 2009, and we're pretty confident that it's not as exposed as many other banks to this policy decision. Yeah.
All right, let's move out of the banking sector for a minute here, and let's focus on those consumer stocks, many of them trading above 20 times earnings. So they look expensive. There's no question about that. But what's your feeling about those type of companies going forward? Of course, many people going into Nigeria say it's a play on the consumer market, etc. And perhaps maybe that's what is justifying this premium we're seeing. So your take on the consumer space in Nigeria, given the challenges we're seeing on the economic front?
Well, on the consumer front, what we have is a strong case for growing demand in certain industries, especially for households, items that the households will have to afford, and which would have minimal impact on savings and on basically basic expenditure, which people would be inclined to continue purchasing. Now, we have a situation where the demographic actually favors a younger generation, and some companies are well positioned to take this in the absence of foreign competition trying to compete for their brands. For that reason, and for the reason that it's actually very hard to substitute their products, we see growth in top line actually lasting way into the future, 5-10 year future, or probably longer.
But do these justify the valuations? I mean, if you look at the breweries, you look at companies like Nestle Nigeria, many of them trading, like I mentioned, well over 20 times earnings.
Yes. A higher valuation is only justified by strong and high growth numbers going forward. So yes, these industries do portend, or basically show, that there's both opportunity in terms of broad product sales growth, and that goes with Nestle, and then probably category growth for the brewery industries as new products or current markets are stretched, along with the growing population and affording, as people are able to afford this more, even on the overall low income level we have. We are likely to see growth in these numbers and them being sustainable.
Are there any names in that space that excite you right now? I think outside the banks, what I hear people talk a lot about is Dangote Cement. Very few actually point to the consumer stocks because, like I mentioned, they already seem very richly priced.
Yes, they seem richly priced to the extent that I am of the opinion that a lot of focus be put on earnings releases, especially full year numbers when it comes to these industries. That should be expected, based on their high valuations, to justify that sort of position. But then the numbers, the driving factors here is basically population, broad-based, and you don't want to miss that.
All right, Abdul, let's leave it there. Abdul Garba from Dunlar Merrifield.